What's up, guys? This morning I released a video saying that I don't think that chat GPT issue that Alphabet is dealing with is going to be a sort of like long-term detriment to the company's valuation, especially in light of how they're growing the company out. But what I didn't do is tell you how I would want to like trade this particular opportunity. And one of you guys in the comments pointed out that the premiums don't look good for the cash secured puts for Alphabet. And so let's investigate that, because I'm going to show you a way that you can sort of get around that with using covered calls as opposed to cash secured puts in this environment. And so as you guys smash that like button, let me run that intro. What's up, guys, and welcome back to the channel. And so, earlier today I put out a video where I said that Alphabet's current share price of around $95 per share is not cheap enough for me to considering that I'm valuing the company at around $135 per share. So it's trading at approximately 70% of its intrinsic value, which is not bad. And if you were to buy Alphabet sub $100 per share, no matter what price you pay sub $100 per share, I think it's a reasonable price, especially when you sort of think about that quote from Warren Buffett where they say it's good to pay a fair price for an exceptional company. And I do believe Alphabet is one of those companies. However, if you are being greedy like myself, I try to buy things closer to 50% of their intrinsic value. Well, there are some ways you can go about that. The first way is look at the cash secured puts, and the second way is to potentially look at a covered call, which could alleviate a situation that the cash secured puts cannot. And you will understand that more as I go through this and show you sort of like how I think about this. Now, I'm not the be all and end all. You guys might have better ways to think about this. And so if you guys think that I'm wrong or I'm not considering something, look, we're always trying to learn here. And so let me know in the comments below how you guys feel about what I'm going to present here. But disclosure, guys, none of this is a way to tell you guys how to trade this particular security. None of it is even telling you to trade the security. This is just showing you how I think about it. Always consult an investment advisor before you make any decisions for your own portfolio. And so let's get into this. And so here was the comment to the video that I discussed earlier in this video, which was, Ranga Ram said the Google premiums are very low, largely because it's a low beta stock, which makes sense. So, if a stock has less volatility, then of course the premiums for essentially which reflect volatility would be low, despite, and he recognized that despite the high volatility of late. And let's investigate this. He's probably right, but I want to show you guys exactly how I sort of understand this and see for myself if it's cheap or not. Now, in the description of this video is something called the cash secured put or covered call options calculator, and it's being available for free. And I encourage you guys to download it as soon as possible, because once the course is released on this channel, that link will go away. And so this free calculator that I allow you guys to download for free is going to go away, and it's only going to be available to the Patreons and to the folks who take the courses. And so just pointing this out, so when it comes to valuing Alphabet, I think that the current price is very attractive because the share price, $95 per share as a percentage of its intrinsic value is 70%. But I want to know what the CSP yields are if we agree to buy the security at approximately $60 per share, which reflects a 60% price to its intrinsic value. I think, very few of us would disagree that it's a price worth paying for a company like Alphabet, $80 or 60% of its price to intrinsic value. And so that's why I sort of targeted that price. That would be my trigger price if the stock ever got down there anyways. And so let's take a look. And so over here is the code for the cash secured put. And it's a put because there's a P right here. And so this is the year, this is the month, and this is the day. So January 2024 or January 19, 2024 is the cash secured put here. So it's about a year from now, or just under a year from now, because we're in February. And so this is the $80 strike price. It's giving you a premium of in between $5.05 and $5.50. So I'll just go with $5.25. And so let's see what this looks like. And so here's the free options calculator that you guys have access to for free for now. So if you guys haven't done it, grab that calculator. It's free and it really helps you guys. And so, in these blue tabs is where I enter in the data. The rest is pulled. So I put in the ticker GOOG, I put in the exchange NASDAQ. It automatically pulls the share price of the last close. I put in the exercise date, which we know was January 19, 2024. I put in in the strike price of $80 and I put in the premium of $5.25. So you can see it spits out an annualized yield of 7%. Now, the reason why the annualized yield is higher than the current yield is because we are in February now. It's February 11th as of the recording of this video, and so it's less than a year until we get to the strike date, and so annualized it just gets a little bit higher. Now, notice that the net purchase price is $74.75, so that's not bad, because you end up buying the company at 55% of its intrinsic value. However, the annualized yield is not sufficient to tie up this capital for 342 days at 7%. So for a long-term or longer-term cash secured put, this doesn't work for me. I need to generate more than 7%. So as of right now, the comment is correct that the cash secured puts are not value or viable in this situation. However, let's look at a shorter date cash secured put. So just looking at the July 2023s, you can see that the premium is around $3 per share at the $80 exercise price. So let's take a look at the model or the calculator for this. So once again, here's the calculator. So you can see that we put in the same parameters. The only thing we did was change the date to July 21st, 2023, and the premium to $3. So I'm just you can put whatever premium. If you don't feel like you can get $3, you can put $2.50 or $2.85 or whatever you want. But I just put in $3 just as a way to look at what this provides. And so it's better. It's close to a 9% yield. But still no cigar. Now, the other thing that you got to pay attention to is the shorter dated you go, the annualized yield will go up, but the actual dollar value, the premium goes down, which means that your net purchase price goes higher. So that's a relationship between shorter dated and longer dated cash secured puts. The longer dated you go, the lower the annualized yield is. However, the higher the net purchase price is, the lower the net purchase price is. And so that explains to you guys why I always look at long dated cash secured puts, because I'm more focused on getting that net purchase price down than I am getting a high annualized yield. Remember, rule number 1 is don't lose money, and rule number 2 is don't forget rule number 1. There isn't a rule there that says maximize your return. So I don't focus on maximizing my returns, and that's where I'm a little bit different than a lot of YouTubers out there. I do not boast or talk about how high my returns are. The only thing I focus on this channel is downside risk. That's why I'm different. And so what we've seen here is that either that 7% or that 8.5% annualized yields for the long dated and the medium term dated, they don't work. And so the comment is right. The cash secured puts do not provide a reasonable opportunity. However, there's one thing that could bail us out in this situation, and that's the at the money covered calls. And so let's take a look at the at the money covered call in this situation. And so you can see here, this is the January 19, 2024 call. So that's why you see the C there. And it's the $95. So this is the at the money covered call, and you could probably sell it for around $15 per share. You might have to be patient. You might not get it in one day, or you might have to wait a couple of days, but you might actually be able to sell this at $15. Now, the way call options work is you have to buy the shares first and then sell a covered call on it. So this is something that I may consider. And here's why. You can see that the parameters once again are the same. I'm using the second tab here, which is the covered call calculator. And so that will be in the free covered call and cash secured put options calculator. So once again, download it before I take it away, and it's going to get taken away from the link of all the videos. In fact, I'll just eliminate the link itself. And so download it as soon as you can. And so, the current share price, you'd have to buy the shares at $94.86 per share. And then you can sell the covered call at the money at this $95 per share, and you get a premium of $15 per share. Now, here's the thing. If the shares run from 95 to 135, you do not get any of that. All you get is this premium. However, if the shares decline further, well, you have a $15 per share buffer before you get put into a loss position. But is it really a loss position if you're willing to own Alphabet at $80 per share, which is the net of these two numbers? In fact, your net purchase price will be lower because you'll buy it at $94.86 per share. You'll get a premium of $15 per share, hopefully. And so it's the $94.86 less the 15, which gives you the $79.86. So that $79.86 reflects less than 60% of the intrinsic value of the company. So even if the shares were to collapse, you're fine because you got it at a share price that you wanted. However, the story with covered calls is that you don't get the upside. However, I'm not focusing on the upside. I'm focusing on the downside. Now, how much do we get paid for entering into this covered call situation? Well, you get an annualized yield of 17%. So if the share price runs, we at least have earned a 17% annualized yield on deploying our capital in this situation. If the share price stays the same or declines, we have a cost basis of $80 per share. So this is how I would play this type of opportunity because I'm not comfortable buying the shares at the current share price without reducing it, at least with a covered call type of opportunity. So I'm going to look at this more on Monday and see sort of like where the premiums land. I'm looking to deploy more capital this year. So this might just be one of those opportunities. 100 shares is just, 9,500, because the share price is $95. So that's not bad. It's something that I would be interested in. It's not a large position, but it might just be a nice starter position. Hey, the share price might come down even further this year, and it might call for a double or a triple down as Alphabet gets continuously mispriced in this environment. So we'll see how this plays out. Now, the other thing is, if you missed that video where I talked about this particular opportunity, you can actually get to that video right here.